You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional-grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody. That music means we are back, kicking off a new year for the Futures Rundown. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network. I want to take a second here at the start of the year to thank everyone who made the Futures Rundown such a hit. The latest addition to our network, just coming in towards the tail end of the year. But you folks have really embraced it. So glad to see that. So thanks to all of you out there who downloaded, streamed, subscribed, engaged on social media, left a rating, whatever you did to engage with the show. We thank you all out there. And of course, if you want to go above and beyond in the new year, including join all the folks who joined us over the holidays, hello to all you folks out there as well. Head on over to the pro, theoptionsinsider.com/pro. Got 2 exclusive shows coming at you over there, as well as giveaways. Oh, it's almost time. Actually, we're beyond time to give away the Pro Trading Crate for the month of December. So look forward to that coming soon. You check it out for yourselves. Get your name in the hat. Get the exclusive shows. theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old Futures Rundown for today, I'm pleased to be joined by a newcomer to the program and indeed to the network. He is Dana Samuelson, the founder and president of the American Gold Exchange. Dana, welcome to the Futures Rundown program.
Hi, Mark. It's great to be here with you. Thanks for having me on.
And Dana, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the world of metals, as well as what you do over there at the American Gold Exchange.
Well, thank you. I'm a 44-year gold and silver, platinum and palladium market participant. I'm a physical precious metals dealer and a vintage U.S. gold and silver coin expert and dealer operating out of Austin, Texas. I got my start working in a vault in 1980 at the tail of the first big bull metals market, because I could be trusted. I spent 18 years learning my craft, buying and selling and appraising vintage U.S. gold coins and modern bullion coins. And I finally got the guts to start my own company in 1998. That was 26 years ago. This will be our 27th year. And I follow the gold and silver and platinum and palladium prices daily because of that, and all the forces that affect the precious metals prices up or down as a result of that as well. So I'm kind of a nerd with precious metals and a wonk with geopolitics, economic information. Follow the dollar quite closely because that tends to have one of the biggest effects on the price of gold and silver in the short term. And then, economic considerations and geopolitical considerations as well. So it's never a dull moment. It's always exciting. Something new is always happening that'll push the metals prices around. And I've gotten pretty good at, understanding where support and resistance levels are in the metals, what drives them when we get a run like we had last year, what could push them lower. So I've got 44 years of accumulated experience and wisdom now with gold and silver. And I'm trying to, share whatever I can with your people to the best of my ability.
Never a dull moment in the metals and never a dull moment in the trading pit. So let's kick it off with our first segment for the year.
It's time to break down all the action that's lighting up the futures markets this week. What's limit up and what's crashing and burning? Let's find out. It's time to enter the trading pit.
All right, everyone. Welcome to the trading pit, our first trading pit segment for the new year. And let me just let you know at the top here, we're going to do our year in review coming up shortly here. We have been putting out a lot of year in review content. If you want some year in review that angles more towards the futures, check out the episode of TWIFO we did last week, this week in futures options. Obviously, it's more on the options front, but we do talk a lot about the underlying movement over there. But we have Dana joining us today, so it's a good time to go deep into all things metals, and we're going to focus on that. We'll come back to a full year in review on a future episode. But that said, looking back on the mad year that was 2024, one of the things that stands out from a futures perspective is the performance of the metals. In fact, I'll give you a little spoiler, a little glimpse of our top 10 and bottom 10 rundown for the year, because number 6 on that list, listeners, was indeed a precious metal. It was silver, up nearly 25% on the year, 24.98 to be precise. And then right behind it, we had the king of the precious metals, which was gold, up a little bit shy of that, about 24.5% on the year. Either way you cut it, pretty darn good years to be a gold bug or just a precious metal head in general. Maybe with the possible exception of palladium, listeners. Not a great year to be a palladium bull. In fact, another spoiler for our year in review show listeners. The number one percentage loser, the number one loser for the year that was 2024, listeners, was indeed palladium, off nearly 11% on the year. So kind of a rough year, but also a very intriguing year from a precious metals perspective. Dana, obviously, when you're not talking to us, you spend your days knee-deep in the metals trenches. As you look back on the mad year that was 2024 from a precious metals perspective, what really stands out to you?
Well, we did have a very big year for gold and silver. What tends to happen is gold and silver will make a run like they did, and then they'll go into a consolidation phase. And we're in a consolidation phase now. Gold was driven by a whole host of different driving forces. One was a weaker dollar. One was the geopolitical tension rising with a second war that evolved after. We've had the Ukraine war going on since 2022. And then, of course, in late 23, Israel was attacked. So we've had 2024 was a year of conflict in the Middle East that just got bigger and bigger as the year went on. That helped to drive gold. But I think the biggest underlying factor is following the Russian invasion of the Ukraine and the U.S. sanctioning Russia and seizing assets, we had the birth of what some call the de-dollarization movement, where countries around the world looked at the U.S., and the U.S. is the world's reserve currency, the dollar, and said, well, if they can sanction Russia and seize assets, they can do that to us. So they want to trade less in dollars, but they really can't because there's no good alternative to the dollar. But what there is a good alternative to as an asset to hold that can't be seized or sanctioned is gold. And central banks around the world, for the third year in a row in 2024, bought near record amounts of physical gold, which is a big, big development. They bought about 1,089 tons of gold in 22, 1,037 tons of gold in 23, and I think the figure for last year, 24, is going to come in about 950 tons, which is double what they've been buying on average over the previous 10 years. So there's a big, big amount of physical buying of gold that has underpinned the gold price. And cumulatively, all of these factors came into play in 2024 to make gold finally break out over 2070 an ounce and run all the way to 2801 in late October before we went into the correction and the consolidation phase we're in now. So that's what's driven gold to record highs. And I don't think the trend is quite over yet. I think we still have one more big leg possibly ahead of us, potentially taking gold into the low 3,000s, 3,200 to 3,400 perhaps. We'll see.
Interesting. We'll get to our predictions in a second, sir. We're going to tease the folks with that out there. But
okay.
It's interesting. You mentioned, obviously, the little bit of the correction we saw towards the end of the year. Obviously, these numbers for gold and silver would have been even higher if we cut them off in, let's say, Q3 or something like that. So a wild year out there on the metals front. I'm curious from your perspective, Dana. We don't have a lot of people coming on the show who interact with the physical market in that level of detail on the show. So I'm curious from your perspective and from the physical end user, end consumer perspective. Obviously, this was a big story for us in the financial world. People who cover the markets, engage with the futures world. We knew that gold was on a good run this past year. Did you see this translating into the world of physical? Were people coming into your exchange, Dana, and saying, price of gold is up. I'm interested in either buying more or perhaps unloading some of grandma's silver? Did you see this translate into the end consumer? Was it translating into a lot of action on the gold exchange?
Yes, it was, but unusually so, in that we had more sellers during the first part of that wave over 2,100, leading into about the 2,400 phase. Profit takers, I think inflation's bite has gotten into some people's pocketbooks to the point where they had to look to what can I raise some cash with to maintain my standard of living. I think that hurt a little bit. We also had some long-term holders that were seeing the gold price, hitting new highs. Maybe they inherited gold. They're not the original primary buyers of physical gold. And they were saying, hey, look, I can get an all-time high, so I'm going to go ahead and shed. But the real factor that has made this run up in gold different than, say, what we had during the great financial crisis when gold ran from 800 to 1900 between 2008 and 2011 was there's no fear in the U.S. markets in this run up in gold. It's a global gold run more than it is a U.S. fear-driven market. And gold tends to climb a wall of worry better than just about any other asset. Part of that wall of worry is what I discussed with two global wars. But the U.S. buyer was very complacent this year for precious metals. Now, we've seen that kick in over the last 4 or 5 months, the latter part of the year, once gold got over 2,500, into the 2,600 range and held. I think the FOMO market, kind of kicked in, where fear of missing out for further gains. But this year was unusual in that it didn't have a lot of buyers of physical gold chasing the market higher. We saw some profit taking during the first wave, and then finally some buying kick in during the latter part of the year. So that was a bit unusual.
I kind of wondered if the gold craze had peaked, Dana, when we saw all those headlines of Costco selling out of gold bars in 5 minutes. Maybe the gold has spilled over. Maybe we've hit peak gold when Costco is unloading gold in 5 minutes. So there we go.
Yeah, they sell a lot of it. I was actually watching, I watch the futures market every day. I trade it for hedging purposes for my inventory. And you can see the computers trading the market. And actually, in late October, I saw a little squiggle up and then a little pullback, very tiny, and just a little right shoulder rollover. And you could almost see the algorithms just exhausting themselves. And I said to myself, and I called my team, I said, hey, I think we just hit a peak. And but it was just my intuition. And it proved to be correct at the time at 2801.
Well, you mentioned the futures. I was kind of curious about that. What is your use case for the futures? Obviously, you're dealing with the physical on a day-to-day basis. Is when you aggregate enough supply, will you go in and maybe sell a future against it? What is your typical use case for futures against your physical gold?
Oh, yeah. As a physical dealer, we always have to have inventory. So we're always exposed to the market pricing. And when the gold price is moving 4 or 5% on a daily basis, which has happened in this run up, or it can drop that much and on days when we have a really big sell off, and your profit margin on some of the products that you handle are 1 or 2%. If you don't hedge your inventory properly, you just get your butt handed to you by the markets. So what we do is we offset our market liability by taking the amount of ounces we own physically and selling them on the futures market. And as we buy or sell more physical ounces, we adjust our futures position accordingly. So as one goes up, the other may go down and vice versa, but they neutralize each other, and we've still managed to make our buy-sell spread.
There you go. It's the textbook use case for futures, what they were designed for at the end of the day, right? For end users and holders of the physical asset to be able to monetize some portion of that in a more predictable and reliable fashion. Now, we've had a lot of people on the network over the years who are big fans of the metals. Usually they tend to focus on one element. We have a regular contributor on our network who's all in on silver, loves silver, calls it a thief in the night. It could be boring and boring for years, and all of a sudden it explodes, kind of like it did this past year. Then it'll sit around again for a couple of years. Other folks like the king of the precious metals, which is gold, of course. Maybe others focus down the rabbit hole a bit. Maybe some even get base. They go into copper. On the metal spectrum, would you say, the name is American Gold Exchange, so I'm going to guess gold is your primary metal, or would you say there are others that are vying for your attention these days?
Well, we do about probably 60-70% of our volume in gold. The balance of that is mostly silver. We do a little bit of platinum and palladium, but the U.S. public doesn't have much desire for physical platinum and palladium buying or selling. I do like both metals as a longer-term speculation around the $900 level based on their chart trading over the last 2 or 3 years. I think they're pretty safe buys, and all the metals are tradable, whether you're speculating in the futures market or perhaps trading ETFs. For options, it's a little difficult because it's a time factor that you just can't figure out as well as you can a price factor with metals for support and weakness. But we do most of our business in gold and most of the rest of our business in silver.
Well, you mentioned one of the P words. I talked about it earlier, palladium. Kind of a rough year for palladium, off nearly 11%. For some of our listeners who aren't as familiar with the nuances of precious metals, what do you attribute this aggressive sell-off in palladium to over the past year?
Well, platinum and palladium, both of their uses are in automobile catalytic converters, where most of the platinum goes into diesel catalytic converters, while palladium goes into gasoline automobile catalytic converters. So that's the high demand use physically for them as commodities. We've seen in China in particularly 2 things happen over the last year: a very weak economy and a growing dominance in the world of electronic vehicles. So with gasoline engines diminishing in China and their economy weak, I think the use case for physical palladium has been weaker, which has contributed to the palladium price, tumbling year on year. But I do think that creates opportunity. Both platinum and palladium are about 19 times scarcer than gold in the number of ounces that are minted or mined every year. And both have physical structural supply deficits, meaning that the world consumes more on an annual basis than comes out of the mines. But there is reclamation of existing palladium in particular from catalytic converters, which is contributing to about 25% of their annual supply, reclamation of catalytic converter palladium. So I think that's what's contributed to palladium, hitting lows and falling from about 1,100 year on year down to 900 this year, low 900s. We had a threat or a rumor of Russian sanctions of palladium, and Russia exports about a fifth of the world's palladium. Most of the rest comes from South Africa. And when there was a threat of sanctioning Russia, or a rumor that we might do that, in October, the palladium price broke out over a 1075 kind of hard top and got all the way to 1228 in the futures market before it rolled right back over and came down. So that shows you how sensitive palladium can be to an increase of demand or a reduction of supply. And I do think it's, like I said, it's a pretty safe bet as either a trader's buying opportunity looking to take profits at 1,000 or 1,050, or as a longer term speculation, you can get in around 900, maybe a hair less or a hair higher.
Platinum and palladium. A weird year for, obviously, palladium because they're selling off, but kind of a strange one for platinum. All these other metals we're talking about selling off aggressively or rallying aggressively. Platinum kind of unchanged on the year, which is kind of a weird one there. Speaking of weird years for platinum, a bit of a spoiler, listeners, but we are, of course, recording this the first trading week, really, of the new year, listeners. So we have one hot week under our belt so far for the new year. How is this new year shaping up so far from a futures perspective? Who's winning? Who's losing? Let's kick things off to the dark side first. We've got ethanol coming in at the bottom of our list. Don't talk ethanol too much here on the show, but folks not loving it to start the year, off about 2.33%. Above it, we have wheat. The March wheat contract off nearly 3%, 2.9%. Right above it, coming in at number 3, we have Ether. Ether taking a bit of a pause, off 3.1%. If you've been listening to our crypto rundown program, it's been a rough time for Ether. Obviously had a good year, but not quite as compelling as some of the other big crypto assets out there, leading some folks to question whether they want to be in Ether over the long term, or maybe switch to some of the other assets out there. Could be Bitcoin, could be Solana, whatever floats your boat out there. Number 2, listeners, we're going to the meal, soybean meal, the March contract off about 4.33%. And again, the number one loser so far this year is cocoa, giving up about 10% so far, just in the first week of the year. So kind of a wild kickoff to the year for cocoa. Now, to the positive side, to the upside, the green on the screen to kick off the new year, listeners. Obviously, we've been talking about a little bit of red on the screens in the broad equity market. That's going to leave our old friend VIX popping. It's up nearly 4% to kick off the new year. Obviously, I get it, percent of percent. All you vol fans, they take umbrage at that. Just make your peace with it. I did a long time ago, listeners. Number 4, keeping it in Dana's wheelhouse, we've got silver out of the gates hot to kick off the new year, up about 4.8%. Number 3, going back to our old friend Orange Juice, the March contract up 5.5%. Number 2, back to the metals. This time we're going base. It's copper up 5.75%. And Dana, you have good timing joining us on this first week of the year, because platinum topping the charts here in the new year, up over 8% already. I just said it ended the year unchanged. Apparently, it took umbrage at that, Dana, because it is coming out of the gate hot. To what do you attribute this aggressive move we're seeing in platinum to start the year, sir? And also silver catching a nice tailwind as well, Dana. Does that come as a surprise to you, or were you looking for that in the new year?
No, it's just it's hard to call something like that. So, on such a short-term basis, what tends to happen with all the metals, especially after we've had a good year with gold or silver, you tend to get some year-end positioning, which would create a sell-off, which would result in kind of a new year bounce. And I do think platinum in particular was very low in price. I have to look at the chart to see where it actually bottomed, but it was around 910, and it might have actually gotten a little under 900, which I think is a real steal at that price. So I think platinum is just catching a bit of a bid because it was just a little bit too cheap relative to gold and silver, and especially palladium. Now, they tend to trade pretty closely in price, and I think platinum was just playing catch up to palladium, which wasn't off quite as much.
Yes, indeed, here as we keep on rolling, listeners. Interesting, the metals are intriguing for a variety of reasons, and also for a lot of our listeners, their lens through how they engage with the metals market is on the ETF side. And the metals ETFs, in particular SLV and GLD, are different than a lot of the other ETFs we see out there that attempt to approximate some sort of futures market using different baskets of futures that they roll and adjust on a regular basis. There's a legion of issues with those. We've talked about USO. We've talked about the vol products that attempt to do that. All of them have issues with tracking. They have issues with slippage. It's a challenging thing to replicate a futures position using some other products out there. GLD and SLV don't have that problem. They actually hold the physical, which makes them, I think, for a lot of our listeners, more compelling and maybe an easier, more bite-sized, and certainly more manageable way to get access to the precious metals markets in a securities account. You don't need to open a futures account because you can put GLD and SLV in your traditional brokerage accounts. Dana, I'm curious, where do you fall on your use case of, or just your overall opinion of GLD and SLV? Do you like them because they hold the physical and tend to track a little better than other ETFs? What are your thoughts on these?
Well, what they do is they make it a lot easier for people just to buy and sell the precious metals price movement with a point and click of a button, which is, with the physical markets, we have much more friction to the transaction because someone has to make the metal, the integrity has to be there for weight and purity, it has to be insured, it has to be delivered. So if people want to own or harness the price movement of the metals and do it cost effectively with a very tight buy-sell spread and have a true representation of the metal themselves, which GLD and SLV are good at, I like them. And I do trade them myself in my IRA. When I think, they're going to be strong or weak, I will, buy and sell them accordingly. And there are actually some ETFs out there where you can have double the risk or reward. And I particularly like those when you can get some leverage when I'm confident of which way I think the metals will go. So I do like the ETFs. I think they're a great way to harness price movement for a short-term basis. But when it comes to owning gold, there's nothing like being able to hold it in your own hands.
You're into the levered ETFs. Getting a little wild there, Dana. I like it. Good stuff there. Speaking of wild, this factoid came across my radar, and I thought you'd be the perfect person to discuss it with. They may surprise a lot of our listeners to learn, Dana, that we're talking here about buying physical gold. You obviously do it day in, day out over there at the American Gold Exchange. But that act of purchasing physical gold was actually illegal here in the United States for quite a long time, between 1933 and 1974. So for 41 years, listeners, it was illegal to buy gold, or at least to own gold in the U.S. That is probably wild to a lot of our listeners. Dana, I know you were involved in the early efforts to unturn and undo this. So why don't you catch our listeners up? Why was gold illegal for 41 years in the U.S. and why did it finally come to an end?
Well, a bit of a history a lesson or adventure, if you like. Gold and silver and copper and nickel were the U.S.'s primary forms of currency. From the early days of the U.S., the U.S. Mint was established in 1795, and gold coins and silver coins were the primary forms of monetary commerce leading into the early 30s. Now, we had the Roaring 20s, and that led to the Wall Street crash of 1929, which led into the Depression of the 30s. And to increase the money supply, you can't just print new gold like you can print new dollars on paper. and we were transitioning from a physical gold and silver, currency market into a paper currency market, and to enable the U.S. to print more money faster, like we did during the Great Financial Crisis. FDR, who was president at the time, had to do something drastic. So he called in the gold as currency. People had a window to turn in their gold coins for paper money. And then gold was made illegal in 1933. It was seized basically at a price of $20.67 an ounce in 1933. Once they had gotten the gold out of the currency, gold was revalued in 1935, internationally fixed at $35 an ounce, a 75% increase after they took it. And that's where it stayed pretty much fixed until the early 70s. Now, my mentor and the gentleman that helped me learn this market and gave me my best break in life was a guy named Jim Blanchard out of New Orleans. And Jim was always a history buff. And we went off of the gold backing the dollar. See, when we created the dollar as the world's reserve currency following World War II, we agreed to all the countries of the world that the dollar would be backed by gold. So the dollar was basically a representation of ounces of gold in Fort Knox. Well, by 1971, we were printing more dollars than we had gold to back it. So Nixon was forced to take us off of the gold standard, which created fiat currency for the U.S. for the first time ever. And when that happened, Jim Blanchard said, hey, this is going to devalue the dollar over time due to inflation, and the gold price is likely to go up, and people should be allowed to own it. So he spent 3 years, growing a database of people back when there was no internet, there were no cell phones, and he grew a group of people, grassroots, through the grassroots movement called the National Committee for Monetary Reform, and he championed the re-legalization of gold ownership, which was signed into law by Gerald Ford into 1974. And when people asked, okay, now that we can buy it, who do we buy it from? And Jim said, well, I'll sell it to you. And by 1980, he had the biggest precious metals and coin company in the country as a result. And I went to work for Jim in 1982. That was my lucky break, getting a job with Jim Blanchard. So that's the story of how gold became illegal to own and then re-legal to own. And the curious thing is, gold has never been illegal to own in any other country in the world, ever.
Just think, Dana, if you had gotten into the business a little earlier, you would have been a wanted criminal. You would have been on top 10 most wanted in the nation for having the temerity to sell gold.
Yes. That's a little young back then.
There you go, listeners. A fun factoid you may not have known. All that gold you're sitting on, maybe you've got grandma's old jewelry upstairs. Maybe you've got some gold bars, silver bars you're sitting on somewhere else, maybe in a safe deposit box. It would have been illegal. Not that long ago here, you would have been a wanted felon, listeners, for doing just that. What's wanted out there in the futures market today? What's lighting it up from an activity perspective today here in the trading pit? Let's see what's lighting it up out there today, listeners. Let's do a quick top 10. Number 10, listeners, we're going out to the land of crude oil. The Feb contract and WTI putting up about 290,000 contracts right now. Number 9, from energy, we go to the rates, the Ultra T-Bond, 341,000, the March contract there. Number 8, keeping it in the rates, the 30-year, also March, 430,000 contracts on the tape there. Number 7, out to the land of 3-month SOFR. If you're confused by that contract, I know a lot of people are. Check out the deep dive we just did on the show with Carly Garner. All things SOFR. Was a fun, maybe an intimidating one, but a fun one. The D's contract there, keeping things a little bit near dated, 470,000 contracts on the tape. Number 6, to the world of equities we go. The NASDAQ E-mini, 560,000 contracts on the tape there. Number 5, back to the rates, the Ultra 10-year, 578,000 contracts going out to March there. Number 4, also in the rates, the 2-year, also March, 633,000 contracts. Number 3, it is the 5-year note. Again, March, all March, the rest of our list, 1.03 million contracts on the tape right now. Number 2, the S&P E-mini, about 1.4 million contracts. We did notice a little bit of intraday swing, it seems, out there in the equity market, so that's obviously attributing to a lot of this volume we're seeing in the S&P and indeed the NASDAQ. And topping the list yet again, the 10-year note, about 1.7 million contracts on the tape out there. And listeners, if you've enjoyed this episode about all things precious metals, maybe you want to dig deep into a little bit of gold, well, by all means, check out our episode. We just did episode 4 from not too long ago on the show here, listeners. We did a deep dive into the contract specs for the big gold futures. You could see how that works, how the pricing works. We walk you through examples. So if you're intrigued by what Dana has been laying down here on the show today, maybe you want to dig into a little bit of the gold futures contract for yourselves. Again, go check out episode 4 if you missed it. We do a deep dive into gold. Before we roll on out of the trading pit, Dana, you mentioned some of your outlook. Let's leave our folks looking ahead a little bit, Dana. You said you're looking for a little bit of an upturn in silver and gold. So you think that's coming maybe early in the year, Q1, Q2? What is your time frame for this little bit of resurgence? I believe you said to 3,000 or 3,100. And then what else is on your radar for the metals market in 2025, sir?
Well, I think gold is the fundamental factors that have driven gold to record highs in 2024 are still primarily in place. We've got a headwind right now where the dollar has gotten much stronger over the last 6 weeks, 8 weeks since Donald Trump was elected, and that's giving gold a bit of a headwind. We saw the same thing happen when he was elected in 2016. For 2 months, the dollar rose and gold got knocked down actually about 10%. And then by the end of February, both of those had reversed back to where they were to start with. So I think we could get a bit of a bump in the metals over the next couple of months. But, you know, the wild card is I think the Trump presidency and policies are going to be much more dominant than what the Fed might do over the next couple of months, which usually is more impactful for all markets. So I'm tending to look a little bit farther out, Mark. I'm looking towards, the end of the year for 2025 to see gold gain another 10, 15, maybe 20%, and silver potentially gaining more. Silver tends to play catch up the best to gold and get the biggest gains late in a gold bull market, not early or a midterm gold bull market. And if this was a baseball game for gold on this run that we've been on, which has been really great, I think we're in about inning 6. I think the best is yet to come, but I don't know what's going to happen in the next couple of months because we don't know exactly what policies President-elect Trump will enact, and all the markets are going to knee-jerk to whatever he does or doesn't do. I wish I could give you a more precise answer for the next 2 or 3 months, but I think there's a bit of a wild card in play here.
Yes, there is a quite literal wild card in place right now, which makes things interesting from a metals perspective. Before we roll out of the trading pit, one other topic I want to discuss with you, Dana, because this comes up seemingly all the time whenever we bring up gold on the network these days, is the relationship to all things crypto, in particular Bitcoin. Ever since Bitcoin emerged into the mainstream for a lot of people back in 2017, it's been called by a lot of folks digital gold. They've made arguments pro and con against that. I've always kind of taken a bit of a dismissive tone with that. I mean, looking at some recent years where you would expect Bitcoin to do well in a high inflationary environment, we didn't really see Bitcoin perform that well. In fact, over the course of the past year, the correlation between gold and Bitcoin was kind of negligible. It was a negative 0.2 roughly, listeners. So kind of an almost uncorrelated year between Bitcoin and gold. I'm sure people bring this up to you all the time. Where do you fall on this debate? Is Bitcoin digital gold or not, Dana?
Well, I've heard Lawrence Lepard, who's a very smart guy and an analyst, call Bitcoin digital gold and gold analog gold. And I do think there's a place for both in a portfolio. What Bitcoin does better than any other asset, and this is one of the things gold was good for a while, is moving money over borders, which is hard to do with just about any kind of a currency in large quantities privately, and including gold. So that's really Bitcoin's biggest asset. It's been adopted by the mainstream now. We've got a Bitcoin ETF, of course, and we've got institutions like BlackRock in Bitcoin. It's much more correlated to mainstream assets than it ever has been before. I do think that Bitcoin has probably shaved $400 or $500 off of what might have been the gold price if Bitcoin didn't exist. And I did see one very interesting trading day in November. it was Veterans Day on November 5th when the bond market was closed. And on that day, Bitcoin broke out over 82.5, and I think it got to about 91,000 that day. It was a big breakout day for for Bitcoin. And during the same trading session, gold dumped $60. So to me, that was a clear rotation out of gold and into Bitcoin, and probably due to the re-election of President Trump. So there's a correlation there to some degree. That day was an inverse correlation. I do think Bitcoin's a bit toppy here, and it's volatile. Gold's much steadier, much more boring, but sometimes boring is good. So it just depends on, I think, what suits you. As a speculation, I'd be a little scared to trade Bitcoin and really speculate on it because it's pretty volatile.
That it is, listeners. We know it's never volatile. It's your feedback. Let's get to some of that right now.
Ring the bell. It's time to take on all comers in an epic Q&A battle royale. All questions can enter, but none can leave without an answer. It's time for the Futures Free-for-All.
All right, listeners, you know how to get at us at Options on most social media platforms. Questions at theoptionsinsider.com also works. If you come at us through the lens of Twitter, you will see our epic question of the week. Our big VIX guessing game is open for the end of the year. Now, listen, a lot of people played last year. We will reveal the winners of that contest coming up on Friday on Volatility Views, but it is off to the races already. It just went live yesterday for our crystal ball guessing game for the end of the year. So head on over to @options on Twitter, listeners. If you're listening to this week, you will find it pinned on our profile. You get to choose where VIX will close within a range for the year, but more importantly, you can reply or DM to that tweet with your specific VIX closing price for the end of the year. If you're within our margin of victory, you will win fabulous prizes. We actually had, I do believe, multiple winners this year. So very impressive thing to be able to guess VIX a year out. We also added some bonus points for if you guess the high and low closes of the year as well. So you really get 3 swings at bat. So head on over there at Options and make your voice heard right now. In our poll, we're looking at different ranges where folks think VIX will close for the year. And folks are expecting a very spicy year for VIX. Ghost peppery, if I do say so myself, because they're thinking VIX might close the year. About exactly a third of you are saying right now north of 20. 31.6% saying in the 16 to 20 range. 29.5% saying a little bit more mild range, about 12 to 16. And about 5.3% saying below 12. A pretty boring close to VIX for the year. Speaking of things that are kind of interesting to the audience of this show, we spent a lot of time talking about metals here, listeners. Our final question of the week for last year, we asked you folks, heading into 2025, how are you planning to position the equity, solely the equity portion of your portfolio? We gave you 4 choices. No change. You're going to keep riding it because markets pretty much go up these days. Or you're going to start scaling back or going to cash. Or you're going to stay long, but with an aggressive hedge. Or, again, getting back to the subject of our show today, you're going to pivot to gold or maybe crypto or some other, let's say, non-correlated or inversely correlated asset class out there. And Dana, about 45.2% said they're going to keep their equity portion as is. They're not going to change their allocation. They think market's going to continue to go up. Maybe they're regretting that so far in the first week or so of the year. 28.6% said you're going to start scaling back that equity allocation, maybe start going to cash. 21.4% said you're going to stay long, but you're going to hedge pretty aggressively. And then, again, we were talking about metals all episode, Dana. About 5% are going to pivot to gold or crypto or some other asset class. Does it surprise you, Dana, that the percentage is that low given the performance we saw for the precious metals last year? And Bitcoin, I should add, too.
No, I don't. The equities markets have just been so strong. It's hard to go against a developed trend. But if they roll over hard, I think that 5% might go to 10 or 15%, exiting into other things. Because I do think that valuations for equities in particular, are sky high. With the P&E profit ratios are just so high relative to earnings that they're historically, at all-time highs. So that would bother me a bit as far as trying to preserve what I've already gained. I would tend to go with the, stay long but hedge aggressively where I can.
All right, listeners, that music means we've come to the end of another fun journey through the world of futures, our kickoff show for the new year. Dana, I want to thank you for joining us to kick off the new year, talking about some precious metals. If folks are intrigued, they want to check out what you have to offer over there at the American Gold Exchange, maybe talk some metals with you, where should they go? What should they do, Dana?
Our website is the best place to go. The address is www.amergold.com. You can send an email to info@amergold.com. Or if people want to talk to us, they can just call us at 800-613-9323. We're consultative in nature. No trade too big or small. We'll try and help everybody to the best of our ability. We get a lot of repeat business and referral business because we just try and help people in our little world as best we can.
There you go, listeners. Check them out over there at AmerGold.com. Get some of that illegal gold, well, formerly illegal gold, while the getting is good. And while you're checking things out online, you know where to go, ctsfutures.com. The folks who are helping to bring the futures rundown to you. Or you can search for T4 Futures and Options over there. Get a free month out of it. You head on over to ctsfutures.com. Make sure you tell them you heard about them on the Futures Rundown. They'll be very happy to hear from you. And it's a great way if you want to start implementing all of these trading ideas and start investigating these markets that we've been talking about now week in, week out for a few months here on the show. That's the place to go, ctsfutures.com, to kick the tires and light the fires. That's going to do it for us on the network today. Remember, we're dark tomorrow in honor of the President Carter Memorial. Markets will be closed. Back again on Friday for Volatility Views. We will look back even more at the mad year that was 2024. We will also reveal the winners of our 2024 VIX crystal ball game. It's some surprises in there. Should be a fun one. And then back again next week all the way through to next Wednesday, another episode of the Futures Rundown. Stay safe out there, everybody.
Thank you for tuning in to the Futures Rundown, proudly sponsored by T4 Futures and Options. Experience the T4 Futures and Options trading platform with its seamless desktop and mobile applications, low latency, and professional functionality tailored for traders and brokers alike. Take advantage of T4 Theoretical Sheets, Strategy Solver, MBO, Advanced Charts, and much more. Empower your trading journey with T4 Futures and Options. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.